Hi, everybody. This week, we are going to step things up and start talking about two chapters. So we will be covering chapter 6 and 7 this week. So this video will be chapter 6, and then stay tuned for another video on chapter 7. So chapter 6 moves on, continuing to talk about our various schemes. And then at the end, we'll briefly touch on the human factor. So let's start off by talking about our corruption schemes. So in this idea, when we're talking about corruption, we're talking about things like bribery or illegal gratuities, economic extortion, conflicts of interest. These are all the things that we're typically talking about. Typically, when we think about bribery, it's defined as offering or giving or receiving something of value to influence an official, meaning like a government agency or employer. But we're in this sense talking about commercial bribery, which is basically the same thing. We're giving it to influence a business decision rather than some sort of influence within the government. When we think about the idea of illegal gratuities, this is very similar to a bribe, other than it happens after the fact. So a bribe happens before the decision and a gratuity happens after the decision. That's kind of the main difference between those two. Extortion, that's like the pay up or else, refusal to pay would lead to some sort of harm to your business. And then finally, conflicts of interest. These are just an undisclosed economic interest in a transaction that could adversely affect your employer. So those are kind of the four big classifications that we're going to talk about today. So first, let's talk about this idea of bribery. Again, it's this idea that we are giving something of value, and we'll talk about that in a little bit. Like, what is this thing called value under the table? So it's going to go from whoever is trying to influence to someone within the organization. And the reason is so that they can get a step ahead in whatever it might be. So the two broad classifications we have are kickbacks and bid rigging. So we'll talk about both of those in just a minute. So the first one is kickbacks. So kickback schemes involve submission of invoices for goods or services that are either overpriced or completely fictitious, similar to the billing schemes that we have talked about in past videos. So kickbacks are classified as corruption schemes rather than asset misappropriation because they're going to involve collusion between the employees and the vendors. In an asset misappropriation, we would have no outsiders that would be knowingly participating. They end up getting roped in, but they're not knowledgeable about their participation. So in a common type of kickback scheme, a vendor would submit a fraudulent or inflated invoice to the victim company, and then the employee who's colluding with that business would help to make sure that that payment went through with that false invoice. And then for their assistance in making that false or inflated invoice go through, the fraudster is going to get some sort of payment from the vendor to make sure that it went through. So that's kind of the typical kickback scheme. So these are almost always relating to the purchasing function. So it's those responsible for purchasing that are typically going to be targeted with kickback schemes because they have to make sure that those payments are going through. So that's usually a purchasing function. So diverting business to the vendor. So we have two different ways that we can do this. So diverting business to the vendor either by directing excess businesses to the vendor. So in this case, we might have the kickback is just direct access to the business. So There might not be any overbilling involved in this case. The vendor is simply just paying the kickback to ensure that they have a steady stream of business from this company. So that's diverting business to vendors. And then vendor is no longer subject to economic pressure. So you might think, well, if there's no overbilling involved and, they're just giving this person a little bit of money to make sure that they continue to work with them, little gifts here or there, what's really the harm in that? And the problem is that the vendor would no longer be subject to economic pressures, and therefore they could raise their prices. And there would be no reason for them not to, because they know that they're going to be getting this business. So because there's no longer subject to the normal economic pressures of the marketplace, the vendor doesn't have to compete with other suppliers for that company's business and has no incentive to continue to provide low prices or quality merchandise. So because of that, that's why kickback schemes are still a problem, even if overbilling or fraudulent billing is not taking place. So overbilling schemes, as the name states, is where the vendor is actually overpaying for the goods. So they are charging more than they should be, and the employee is making sure those go through. So typically employees with that approval authority are going to be the ones that we would think of having that issue. However, it could also just be that the person doesn't necessarily have approval authority, but the person that does have approval authority is one of those rubber stampers, or is inattentive, or is forced to kind of rely on their subordinates' guidance on these purchasing matters. So it doesn't necessarily have to just be those that have that authority. So how this is going to take place is the vendor is going to submit that invoice, and the employee is going to make sure that it gets paid. You'll see this, or ways to look for this is to look for overstating the cost of goods and services, looking for the prices and making sure that we're not overpaying, and making sure that they're in line with what we would expect those to be. Some other kickback schemes that we might see is where the potential purchaser is going to seek a lower price from the victim company. So the employee could sell the purchaser goods at a lower price in exchange for the bribe. And then finally, we have the slush fund. So how is the person that's doing the bribing going to pay off the bribe? Typically, a company isn't going to allow payment of bribes, so they're going to have to figure out a way to get those funds from their organization to be able to pay for those bribes. And this is what we call the slush fund. So in order for the person to be able to pay the bribe, they first have to divert company funds into an account in order to make those bribes. And that account, again, is called the slush fund. So how are we going to have those disbursement of company funds into a place where we can make those fraudulent payments? When we think about preventing or detecting kickback schemes, it's going to be very similar to the billing schemes that we've talked about, but an added component is that they're going to include active participation of a vendor in a fraud. Because of their similarity with the billing schemes, the controls that we had talked about are going to be the same. So separation of the purchasing duties, authorization, receiving and storing goods, cash disbursements, maintenance of an updated vendor list, reviewing and matching of our supporting documentation. All of these things are going to be the same. However, because we have this collusion with that outside party, it might be difficult to catch these. So some things that we can do in addition is looking at our actual expenses to our budget. looking at what is normal. So maybe looking at the cost that this vendor is charging compared to like the market rate to make sure we're getting decent prices. That's the idea of monitoring the trends to see if we can find things that look a little out of line. Bid rigging. So bidding, before we get into this, let me just talk about what this bidding is. So oftentimes, either organizations or government agencies will require a bid to go out for big purchases. So they will post this maybe in their newspaper or in industrial journals or on their website somewhere, where it's like, hey, we're going to do this big project and we want people to bid on it so that we can get the best price. This might be called an RFP, or request for proposal. So what happens in big bid rigging is some vendors are going to have some sort of insider influence. So they're going to have some assurance that a vendor is going to win the contract. And this, again, it circumvents the whole idea of this competitive bidding process, because if we're giving influence or preference to certain bidders over the others, then it's really not competitive. So this can happen at 3 different stages. So it can either happen pre-solicitation. So before we even post the ad that says we want people to come in and bid, we could have some things happening there. It could also take place in the solicitation phase. So as we are getting these bids in, and then finally in the submission phase when we are ultimately awarding the bid. So let's talk about each of those. So pre-solicitation phase. So this is before the bids are officially sought for the project. So there's 2 different types of schemes we can see here. So there's the need recognition scheme or the specification scheme. So in the need recognition scheme, basically the company doesn't really need to put out this bid, doesn't really need the goods or product, but because we are talking about corruption here, the company is going to ultimately purchase unnecessary goods or services from a supplier at the direction of this corrupt employee. So the employee is saying, hey, we really need this, when we really don't. So that's the idea behind need recognition schemes. Then we have specification schemes. So specifications are what in the ad we are stating we need. So when people are bidding on something, what it is, the materials or the dimensions or the requirements that are necessary to complete this project. So we can have a couple of different things happening relating to these specifications. So the first is that we could tailor the specifications to a particular vendor. So we could, accommodate that vendor's abilities and make sure that they are the best suited vendor for this particular bid. The second one is we could have some sort of pre-qualification procedures that would eliminate competitors. So an example that your textbook gave was a requirement that the company is 50% owned by women. Well, you know that you have competitor X, Y, and Z that are mostly owned by men, so they're going to be discounted, and we're not going to even think about those. But this vendor that is woman-owned is going to be our preferred vendor because we have these pre-qualification procedures that are set particularly to get a specific vendor. Sole source or non-competitive procurement justification. So as we are going through the process of putting this bid together, we say for some reason we need to get all of our goods or products from one particular vendor. So rather than spreading it all out, we are deliberately distorting the requirements of the contract, claiming that we have to have a sole provider for some unknown or illegitimate purposes. Deliberately writing of vague specifications. So this means when we are putting out our ad, we're vague in what's in there. So then at a later date, we can be, whoever wins the bid can ultimately put in amendments and raise the price of their contract because of these amendments after that project is awarded. So they can, so they have a very vague list of what has to happen. So we can put in a really lowball offer, but because it's so vague, after we win the project, then we can upcharge you and charge you more because you weren't specific enough in the beginning. Bid splitting is when we break up a project into smaller pieces to circumvent a competitive bidding requirement threshold. So let's say your employer says anything over 100,000 has to be bid out. Well, instead of doing one contract for 100,000, you do two contracts for 50,000, and therefore you don't have to do a competitive bid. That would be bid splitting. And then last one, allowing a vendor to, or if the vendor pays an employee in order to see those specifications earlier than their competitors, kind of to give them a little bit of an advantage so that they can spend a little bit more time on their proposal. So allowing the competitor, the vendor to see those specifications before their competitors is another pre-solicitation phase scheme. Then there are other two phases, the solicitation phase and the submission phase. So in the solicitation phase, this is when we are advertising that we want these bids to come in. And these schemes would in some way reduce the pool of who we're getting. So in restriction of the pool of competitors. So in this phase, we are trying to get fewer competitors so that we're more likely to win. So bid pooling, here we'll have several bidders that will actually conspire together to split up contracts, and that will ensure that everyone gets a certain amount of work. So we might say, okay, I'm going to bid low this time, you bid low next time, and you bid low the third time, and then we'll start over at the beginning. So the vendors kind of work together in advance to make sure that everyone is guaranteed a certain amount of work. And just like a monopoly, if they're working together ahead of time, they can conspire to raise their prices and inflate prices. We could also have fictitious suppliers. So it might look like we've got 10 bids, but if half of them are not real bidders, we put in our real bid, and then we put in 5 fake bids that are all above the one that we had. This makes our real bid look better because we have fake bidders in there. And then finally, some other methods. We could have we could just like we could show the people ahead of time if we are restricting the time to put together a bid. So if one person has looked at the specifications in advance and has had a month to put their bid together, and then someone else just sees it when it comes out and they've only got a week to put it together, they're going to be at a disadvantage. Also, where we post these ads for solicitation, if we're posting them, we're telling one vendor particularly, hey, we've got this bid coming out, and then we post it in some obscure journal or publication, newspaper, where no one else will see it. That way we're kind of ensuring that no one else will bid against the vendor that we are giving our preference to. And then finally, in the submission phase, so this is after we have gotten all of our bids in and we are opening them up and choosing who our best one is supposed to be. This process is supposed to be confidential, which means we get a bid, it's sealed, and then at the date when we're going to make our decision, all of the bids are opened simultaneously and we choose the best one. So what we could have here is that they are not remaining confidential. They are not remaining sealed until the date that we are making our decision. The bids come in and we're opening them up and we're letting the competitors know. So we're saying, hey, Acme Corporation just bid 3 million, you're going to want to make sure you come in less than that. So that so this could be that we're allowing late submissions. So we've opened all of the other bids, we've seen what they are, we let somebody know, and we let them, either change their bid or bid late. Or we let them see what the other competitors are viewing, giving them information on what they need to do, how they can outbid their competitors. These are things that could happen in the submission phase to circumvent the bidding process. So how can we prevent or detect bid rigging schemes? Again, because we are talking about collusion, it's going to be difficult to find or to identify. But if we are monitoring price trends, if we have an expectation of how much this particular contract should be, and it comes in greatly bigger than that, if we see unusual bidding patterns, so maybe whatever that may be, where we are constantly giving contracts to our last bidder. That would be an example of an unusual bidding process. So whoever's getting their things in right under the wire. If we have unusual high contract prices, higher than we would expect it, that could be an example. The last bidder is always winning, repeatedly winning by just a little bit, so that it looks like they might have been able to look at their bids and they're able to sneak in right underneath that amount. Predictable rotation. So remember, we talked about the idea where, the vendors could work together and divvy up the job, almost like a monopoly. So if we see that vendor 1 gets it the first time, vendor 2 the second time, 3 the third time, and then it starts back over, and we see that pattern that typically wouldn't be there, that could be an indicator. If the losing bidders appear as subcontractors, that again would indicate maybe they're working together. So if I bid on a job and I lose it, and then I go and work for the person that actually won the job, that would be odd. Fictitious suppliers, again, how can we look for fictitious bidders? Looking for addresses, if they all have similar addresses, going and looking for them online to make sure that they're real. These are indicators that those bidders aren't real. Qualified bidders fail to submit. So we would expect we got bids from certain people and we don't see those bids. And then finally, if we have several large projects that are split into smaller jobs, that could indicate that we are trying to circumvent bidding procedures. So something of value. So when we talked about these, one of the things when we were talking about bribery, one of the things is this idea of something of value. That doesn't necessarily have to be money. As you see here, it could be liquor or meals, travel, cars, favors, whatever it might be, promise of future employment. Any of these sorts of things can be considered ways to pay for that bribe. So it doesn't necessarily just have to be, cash in my pocket. Any of these things would be considered something of value that could be used as the currency of a bribe. So moving on to illegal gratuities, again, the major difference between an illegal gratuity and a bribe is the timing. So a bribe happens before the decision is made. Illegal gratuities happens after the decision is made as sort of, a reward or a thank you for doing business with us. The problem with illegal gratuities is that it can lead to further workings with that vendor, and then it could lead into some bribery down the line. So we want to be careful of illegal gratuities as well as bribery. And then the last one that I want to talk about is our conflicts of interest. So conflicts of interest is an undisclosed economic or personal interest in a transaction. And undisclosed is the key word right there. If the employer knows that you have another business, then it's their job to make sure that you're not negotiating terms favorably for yourself. So if it's disclosed, it's not a problem. But when it's undisclosed and we're giving business to our own side hustles, that's when it becomes a problem. Two different schemes we can have here. It can either be on the purchasing side or on the sales side. So let's take a look at these. So on the purchasing side, one thing we can have is that idea of a turnaround sale. So we know that our employer is going to buy lumber. So we go to Lowe's, we pile up a truckload of lumber, and then we go and sell it to our employer at an inflated price. So we, buy $1,000 worth of lumber and we charge our employer $1,500. They could have just gone to Lowe's and bought it themselves, but we are inflating that price and keeping that additional profit for ourselves. So that's the idea behind this purchasing scheme of the turnaround sale. On the sales side, again, we've talked about some of these things already in the previous chapter. So we could have under billings. So here is where we are, instead of selling goods to our employer, we're purchasing goods to our employer, and then ultimately maybe reselling them or doing something else. So in underbilling, we are selling them to ourselves for a discounted amount. So we are getting goods either below market value, taking advantage of something, or maybe even at a loss for the company, because we are buying these goods from our employer below what we would typically be selling them for. Similar to that, we could write off the sales. So we aren't necessarily taking a discount from the sale, but we ultimately don't pay our bill. So we would just write it off. So that's the idea of writing off the sale. Delayed billing, we don't pay in a timely manner. We might eventually pay, but we might take 90 days to pay instead of the typical 30 and not charge any interest to ourselves. That would be another sales scheme conflict of interest area. Business diversion, so some other conflicts of interest. This is where you start a business that is in direct competition with your employer, and you are going to steer potential clients to your own business instead of to your employer's business. Similarly, resource diversion, where we are going to divert resources to develop our own business. So we talked about some of the asset misappropriation. This could fall in line with that as well. Ultimately, the last thing to think about is financial disclosure. So management has the obligation to disclose to the shareholders any fraud that's committed by officers, executives, or others in positions of trust. Management doesn't have to disclose uncharged criminal conduct of its officers and executives. So what often happens is we don't want to, we want to save face. We see this fraud happening. We're just going to, this person is going to have some personal problems and they're going to just resign. We're going to let them go, and we're not going to, make a big thing of it. So that's this idea of inadequate disclosures can be one of the most serious frauds. So we need to make sure that we are holding people accountable and putting out kind of the culture of fraud detection. So thinking about that again, thinking about how we can prevent or detect conflicts of interest. We want to make sure we have disclosures from our employees. We want to make sure we have a policy about conflict of interest and about ethics. We want to make sure we have good disclosures. These are just ways that we can help to prevent or detect conflicts of interest. So as long as we have humans as employees and we aren't just employing robots, we're going to have a problem with fraud. So to help aid in fraud detection and prevention, we need to assure that we have clear and reasonable anti-fraud standards in our organizations. We also need to assure that we have proper internal controls in place and that they're functioning. And we should never rely on trust of an employee. So if, we've had this woman working for us for 20 years, that's never good enough to circumvent an internal control. So putting people in a position of trust or relying on that trust is never a good thing. So no one factor alone will deter occupational fraud. So we need to make sure we have a good system in place and not just one thing. Greed is certainly a factor of occupational fraud, but it's greedy compared to what? So everyone has some level of greed. So what level of greed is going to be enough to entice fraud? And that's where this idea of wages in kind comes into place. So in most of the cases that the book presents, people are choosing to commit fraud against their employer. They're going to feel justified in doing so. And that's where this idea of wages in kind comes in place. So wages are your typical what you expect. And then in kind are those wages that you might not necessarily be entitled to, but that you feel justified in taking. So for the purpose of detecting and deterring occupational fraud, it doesn't matter whether an employee is actually justified in the fraud, but whether they perceive to be justified. So our prevention efforts have to begin with educating the employees and staff and attack this misperception on all fronts. So the morality, legality, negative consequences of committing occupational fraud and abuse. Finally, unreasonable expectations. So one reason that fraud gets committed and people feel justified is that employers are unreasonable with what they expect their employees to do. So we want to make sure that we don't have unreasonable expectations of our employees. Our employees feel that they are being treated well. So they don't have this justification. So employers have to be educated in this idea of wages in kind. And there's kind of three basic things that are necessary to minimize occupational fraud. So first, we have to hire the right people. Second, we have to treat them well. And third, we can't subject them to unreasonable expectations. So those are kind of the three big things that employers need to be aware of. So fraud deterrence. So we have fraud prevention and deterrence. So we kind of had talked about ways to prevent or deter fraud, and we kind of lumped them together. Prevention is stopping the fraud before it happens, removing that motivation to commit it. Deterrence, on the other hand, is modifying our behavior through the perception of negative consequences. So fraud offenders are very deliberate people. They have to think about the fraud, they have to weigh the risks and the rewards of their behavior, and they have to make a conscious decision. So deterrence is ways to think about deterring that decision, making them think about thinking about that decision, thinking about the risks, thinking about the rewards, and making the decision not to commit the fraud. Controls are never perfect. They're the best thing that we have. And controls are only part of how we can deter fraud. So let's think about, I know I've repeated myself over and over and over that we need to have controls in place. We need to have controls in place. But we also have to realize that controls are only one part and are never fully the answer. So the perception of fraud. So in deterrence of occupational fraud, it's going to start with that employee's mindset. So the perception of detection tells us that an employee who perceives that they will get caught engaging in a fraud is less likely to commit it. So when you see fraud, we have to make sure that we are publicly addressing it. We are setting that tone that it's not acceptable in our corporate culture. We can't just sweep it under the rug because we need to make kind of that big show when we do find fraud. But again, we're trying to prevent it from the beginning by having those fraudsters with that mindset of, I'm going to get caught if I do this. And there's detection methods in place, so I can't get away with it. So that's this whole idea of the perception of detection. 6 steps in that prevention. So we want to have proactive fraud policies focused on catching the fraudster, not just punishing the fraud that we see. You don't want the fraud to happen in the first place. So if a potential fraudster thinks that they're going to get caught, they're going to be less likely to do that. So how can we, what are these 6 steps? So first, employee education, educating the employee about the correct ways to do things, the controls that we have in place. Then when we think about having those proactive fraud policies, we want to focus on catching the fraud. What detection methods do we have in place? The idea of a higher stance. So that's bringing fraud out of the closet, asking people to share their knowledge and suspicions about fraud, asking people what possible controls and administrative weaknesses there might be that could contribute to fraud. So getting this feedback from our employees so that we can help with that, and also so that they know that we're aware of what's happening. So if they know that somebody's looking over their shoulder, if they were to commit any illegal act, we are taking that higher stance to show that we are there and we're looking into things. So we don't have these hidden controls that people don't really know about. The employees know that we are looking for these things, that we are being proactive. Increasing use of analytical review. So using big data in your analysis to help predict any anomalies or outliers that could represent fraud, and then investigating those outliers. Surprise audits where feasible. So if the fraudster is aware that an audit is coming, they'll have time to alter, destroy, replace records, and other evidence that there might be. So having a surprise audit would make it more difficult for them to, again, alter, destroy, or misplace records. So if it's possible, having surprise audits to not give them that forethought. Then finally, adequate reporting programs. So there are 6 points that our reporting programs should have. First, we want the program to address the idea that fraud or waste or abuse occur at some level of every organization. So just put it out there that you know that it's happening. Secondly, that this fraud, waste, and abuse is going to cost jobs. It's going to cost raises for everyone else. It's going to cost profits. So we know that there is impact to these frauds. And again, having this aware to your organization. Third, the organization is actively encouraging its employees to come forward with information, and that they're not going to penalize them for that. So that's the 4th one, is that there's no penalties for furnishing information. 5th, make sure that there's a method for reporting, such as a phone number or an address, and that people know that there's that number out there and that it can be made anonymously. And then 5th, letting our employees know that their report doesn't have to go to their immediate supervisor, that they can make it to another employee. So those are things we would like to see in that reporting program. So that ends it for today. Stay tuned for Chapter 7.